We are glad to have you here. My name is Chris Lopez. I'm one of the hosts today of our webinar to come talk about the one big, beautiful tax bill that got passed a few weeks ago. Lots of changes, and some of those changes are going to impact real estate. So we wanted to have a webinar to come talk about the changes and also talk about real estate. I've got my co-host and friend Brandon Schulten from Keyrenter Property Management in Denver. How you doing, Brandon?
Doing great. Excited to hear more on this today.
Yeah, so a few weeks ago, Brandon and I, we do a webinar podcast every month or so together, and we're talking about, hey, what is relevant content that rental investors need to know about? And we both said, hey, it's understanding the OBBB. And so we decided to put on this webinar. I mean, Brandon has, hundreds or thousands of, rental properties he manages for owners. We have tons of investors on our side, and we wanted to just add a lot of value to our respective clients to give them the latest information on a great webinar today. So, Brandon, I'll let you tee it up and introduce our special guest today.
Yeah, well, again, thanks everybody for jumping on here. Thankfully, we got Justin Shore today from Hall CPA that's going to break this down. He'll go through a number of the different aspects of it and try to kind of really focus on the things that are most important for real estate investors. And yeah, feel free to use the chat and throw your questions in there. We'll have some time at the end for Q&A as well. And if you want to do a tax consultation at the end, there's a QR code there where you can sign up to talk to someone at Hall CPA. So, but yeah, I'll kick it off to you, Justin, and you can give us a little bit about yourself.
Yeah, thanks again for having me on, guys. So the majority of like what we'll be talking about today, like they were saying, is focusing this on like more of the entrepreneurial and especially like the real estate investors that are here listening. We've got a few things peppered in throughout that will just kind of affect, almost everybody in general, just kind of on an individual level, just things that we didn't want to completely leave out, but we'll have more of a focus like on the business entrepreneurial side of things, like the impacts for you guys. A little bit quick kind of blurb about myself. So I'm Justin Shore. I'm the advisory manager at the Real Estate CPA and legally known as Hall CPA as well. And our specialty is real estate. Every single one of our clients is a real estate investor. But like they were saying, most of our real estate investors are very entrepreneurial. So a lot of our clients do have businesses in other sectors as well. So that is something that we also consult on kind of almost like secondarily. I myself, I've been investing in real estate for about 10 years now, been practicing for about 13. So I've always been attracted very, very strongly towards real estate, partially for the tax benefits, but also just love all the, investment benefits as well. So that's a quick little blurb on myself and the firm, but we'll go ahead and dive into the bill language here. So yeah, go ahead.
Or one thing I forgot to mention is if they were out there as questions, feel free to drop them in the chat box. And actually, while Justin starts going out there talking, let us know, A, that you can hear us. Just say hi and let us know where you're from. I forgot to do that in the intro on there. Just actually like to make sure that's not just the three of us talking. So in the chat, just let us know you can hear us and let us know where you're from. All right, I see them starting to come in. All right, Justin, back to you, sir.
All right. So as you may know, or if you didn't know, the bill was passed on the 4th of July. So it's been out there for almost 3 weeks now. A big, thing to keep in mind, I'll kind of put this out there as like a prefix here, is the IRS committed to getting regulations out for all of this within 90 days of the bill passing. We're not holding our breath on that. It'd be great if they do get that within 90 days. But everything that we're kind of looking at here is just how everything stands in the bill. And for a little bit of that context, why I bring that up is it's important to know Congress essentially passes the bill, puts it into law, but then from there, the IRS then has to interpret the legal language of the bill and start writing that into code and regulations. So that's where we'll see a little bit more expansion on some of the details and a little bit, hopefully, clarification on some of the things that have not been really stamped out super black and white. So I'll try to kind of point those things out as we're working throughout the material as well. All right. So this one, just kind of like I said, could potentially affect a lot of people, whether you're a business owner or one of these types of employees, is the no tax on tips. This was a huge pledge on the campaign trail to get this one done. There are various limitations on this. For example, the adjusted gross income limits for 150,000 for single folks, 300,000 for joint. If your income is over that, they start phasing out this benefit on the no tax, like on tips. And this is one of the provisions that is effective for 2025, but does expire in 2028. I'll try to point some of those things out today too, as we're working through this, things that do expire, things that don't expire, if there are cliffs, so to speak, anywhere with some of these, because each one of them is a little bit different. Qualified tips. So one of the things that we had a lot of questions from professionals about this, if people own their own businesses, is like, is there going to be a way that we can maybe like restructure our compensation in such a way? Like, for example, if you are an S corporation owner, maybe like as a, maybe you're flipping properties, or obviously real estate agents earning commissions might have like S corporations set up for that. We had a lot of questions around that of like, could we restructure our compensation to include some amount of like tips? Well, they did think about this at a time, the bill language. There are exclusions to the types of businesses that will qualify. In general, the best way to kind of summarize the businesses that are going to be allowed to utilize this like for their employees are going to be the types of businesses that you would typically expect traditionally that would have tips. Things like restaurants, bartenders. They did at the last minute add in people that are in the esthetician type of line of work, like hair salons and like nail salons, things like that. So unfortunately for us, like as our accountants, like at our accounting firm, we won't be able to restructure any of our compensation as tips to be able to like take advantage of this. So definitely something that's out there, could be changing a lot as far as like things I would anticipate, like the restaurant industry and whatnot's going to be affected pretty heavily by that. Right. Let's go ahead and jump on to the next one. Similarly, we've got the no tax on overtime. This is another huge, campaign promise from Trump when he was running. This is another one that is just a temporary 2025 to 2028 provision. And there are some very, very similar caps. We've got same AGI caps we had with no tax on tips, with it being the 150 and 300K, as you can see here. And they are putting a limit on this, limiting, the deduction to 25,000 for like married filing joint. As you can imagine, again, this is a method for to keep employers from, erroneously taking too much advantage of this and trying to structure your staff's income as having mostly overtime income or something like that in order to be able to get, lower their taxes beyond what's really intended here. But this does mean that we're going to see either a new box of some kind or some new codes on the W-2s that will indicate what your overtime pay was. So that'll be something to kind of be keeping an eye out if you are someone who's in that, if you do have like a W-2 position, you are earning overtime. That'll be something different that's never been seen before. If you're self-preparing on TurboTax, or you've got a tax preparer that is, hopefully they're keeping up to date with this stuff, but that's going to be something that they'll want to definitely keep an eye out for. Come January of next year, we'll have some new numbers or new forms or chunks of the forms at least being added here. So kind of exciting on that. I'll be interested to see how many people end up being able to take advantage of that. And it is specifically just on the chunk of additional compensation that is overtime. We've kind of got this outlined on the box on the left there, number 1. But it's, if you're say earning time and a half, it's just that extra half that's getting like put into the no additional tax. So not necessarily like excluding that entire chunk of income from tax, if that makes sense. So I'll move on quickly from those, since those are just kind of individual type items here. Now this one, we've gotten a lot of questions on as well. No tax on car loan interest. And it's for any of the business owners here that are listening to, this is not to be confused with if you have a S corporation, or even if you have a Schedule C business where you're operating like a sole proprietorship and you do have a business vehicle. This is separate from that, because your interest on auto loans for business use vehicles was deductible prior to this. So you will still have that. This isn't making any kind of modifications to it. This is actually more specifically for interest on car loans for individuals. So this would be something outside of your business, on like your actual personal auto. This one, it's gotten a lot of attention, a lot of attraction in the news from what we've seen over the last really kind of month or two, because this was in an earlier version of the House bill, but in one of the earlier iterations before it got passed. It is a nice perk, but it's maybe not quite as much as it's been kind of talked up to be. And the reason why I say that is there is a phase out range for like who can take advantage of this. We have that here: 100,000 if AGI if you're single, 200,000 if you're married filing joint. And they always do this with these phase out provisions where they put in some kind of like layering tiered kind of system where a $200 reduction takes place after every $1,000 of income that you have over that 200,000 if you're married filing joint, for example. So it's not that you completely lose the ability to take it. It's that they start taking small bites out of that deduction that you can take. So the reason why I say like it's a nice small perk, but not probably as exciting as a lot of people are thinking, is because if you think about realistically, how much of a deduction can you really generate or take with this? Like, I don't want anybody necessarily thinking like, oh, I'm going to run out and buy a new car because I'll have this huge advantage of getting to deduct loan interest. Because let's just say if you buy a vehicle, for say like $50,000, so it's a new car this year and you have like a 6% interest rate on that. By the end of the year, and this would be like a full year of interest, so maybe even going into say it's 2026 that you're using this as well, it's only going to be about $2,700 in interest payments that you would make like in that first year on like a typical 5-year loan. Excuse me. So if you're saying like a 22% tax bracket, that $2,700 deduction is only going to save you about $600 in federal taxes. So like I said, it's nice that it's there. It might be something that you can tap into if you are a taxpayer who's, in below these phase out ranges. If you're too much higher over the phase out range, like specifically if you're over 250, that's when the phase out would fully take away this deduction. Then it's not something you'd be able to tap into anyways. But I would say like the target market, you could say, target taxpayer for this is married couple households that have a taxable income between 100,000 about 200,000, give or take, because that also means you're in a 22% tax bracket. If you are under 100,000, great, you could still take advantage of this as well. It's just that once you drop below 97,000, you're in a 12% tax bracket, so that tax benefit gets even smaller for like the ability to actually take this deduction. Could be beneficial, but might only mean like a few $100s in savings. If you were looking at, I think when we look at this as investors, I'm always kind of putting on the investor glasses with the situation. Is I was looking at buying a new vehicle versus investing in another rental property. It definitely sounds biased because I'm here talking from the real estate CPA, but I would lean more towards buying an additional rental property because I know I'm going to be able to harness much more sizable benefits out of that as opposed to buying a new car, as much as I would want to. So,
does this apply to vehicles bought in the past, or is it just bought in these tax years?
That's a good question. It does have to be a vehicle that was purchased either this year or between 2025 and 2028. So this would be something that you could utilize like next year for the following year as well. We've got on here kind of this top bullet point with qualifying vehicles. It says original use must commence with the taxpayer. It's kind of typical tax bill jargon to just say that it's got to be a new vehicle that you are purchasing. And one of the other ones I've got kind of point number 5 down here is the final assembly has to happen in the United States. So that, of course, with any kind of tax provision, typically, if they're trying to put any of these regulations in place, it's trying to accomplish some sort of social economic agenda or goal. Agenda sometimes has a negative connotation. I'll say goal. And so like the goal with this one was to encourage people to buy more vehicles that are largely manufactured in the United States. And it's important to know they don't say that the entire assembly has to happen in the US. So if you are wanting to take advantage of this, because you are in that, you're below $250,000 of married filing joint taxable income, you definitely want to have those conversations with the dealers of, hey, is this completely constructed in, Japan and then shipped over, or like where does the final assembly actually occur? And it's not necessarily always the same for just like, it's not all Nissans are done the same way, all Hondas are done the same way. Some of them will have specific lines of their vehicles that do have the final assembly in the US and others that don't. So that's going to be kind of the tricky thing to look out for there.
What type of, if any, documentation does the consumer have to provide, some type of 1099 form? Part of me says I know salespeople, and salespeople will say one thing to get it, to get a sale done. So I always like to have documentation rather than relying on the commission guy who's saying, "Oh yeah, this is built in the USA" or whatever it is.
Right. Absolutely. I mean, I think a trust but verify is definitely a good procedure to follow in that situation. And the sales folks, I think, definitely probing them and asking some of those questions, but then maybe doing a little bit of research online to find out if they are accurate with that. We are anticipating, this is another one of those areas where there will likely be more regulations put out by the IRS where it says like what kind of documentation that you'll need. There's been opinions that either it'll be something that the lender might need to report when they're reporting because the lender is going to be the one that reports how much interest you paid on the loan. And that's not something that the dealer is going to have information on. But at the same time, the dealer is the one that's probably going to have the information on, was this final assembly done in the United States? So that could be something that when we get further guidance on it, that maybe the lenders will put out some direction with that to at least like instruct, hey, well, if you're getting this type of auto loan, we need X number of documentation from the dealer, or vice versa. I would hate to think that it would be 100% on the taxpayer, on the buyer, but the IRS does like to put all the burden on the taxpayer. And not to be evil, but that's kind of their general mandate, is that the taxpayer has all the duty of finding that information. So, but yeah, that's a good question. All right. So, and some of the other items, like it may seem kind of obvious, but like, the requirement of it being manufactured for like public roads and highways just means that we're not talking about, like construction equipment, like something like a bulldozer or anything like that. It's got to be something that's generally made to transport people for the most part. So, all right. We'll jump along here. This is another one, somewhat on an individual basis, but it's kind of investment related. So I wanted to cover this one too. The Trump accounts, as they've been named, new investment vehicle for minor children. So interesting thing with this one is the general idea with it is that, and there's a lot of other countries that have similar types of programs like this that are government incentivized savings programs, is kind of where this stemmed from. And the idea is that they wanted to encourage not just parents, but really any kind of family members or, some friends and family even, to invest in children's futures in a general sense. And the idea behind it is it's very similar to an IRA type of account. If you're familiar with IRAs, the idea being that when you fund that account, it's in this tax sheltered little bubble so that as it grows and that account is generating returns, like investment returns internally, it's not taxed. And because it's not taxed internally, theoretically, it can compound and grow a lot faster compared to if you just had money that you were, say, investing through like a brokerage account in your personal name, where you're being taxed on all the gains that you make every year when you're, let's say, like trading stocks. This would be a tax advantage vehicle to grow that savings account for minors. And some of the odd restrictions that they have here is that there is a $1,000 credit that you can receive if you have a child that was born in 2025 specifically. So it could have been born 2 days ago. They could be born on December 29th. They would be eligible for that $1,000 credit. It's credit is a dangerous term that we have to kind of dissect a little bit, because that sometimes sounds like I'm going to get a credit on my tax return versus like, am I actually just getting the account credited? In this case, what they're going to do is they're going to add, the government's going to add that extra $1,000 funding to the quote unquote Trump account. And that just requires that you fund it at least that $1,000, but the maximum amount that you can put in is $5,000. So there isn't if you have children and you contribute that $5,000 to that account, it is after tax dollars. You're not getting a deduction for making that $5,000 contribution. So that is like an important distinction to draw like comparatively to making an IRA contribution. If it's a traditional IRA, you'd get that deduction. So I would liken this more akin to making a Roth IRA contribution is what it's more similar to. But again, main idea being that like if you do this each year, you can put $5,000 in the account every year. Hopefully it grows and compounds a lot to where when the minor child turns 18, then they've got this chunk of funds that maybe can be used for either secondary education, like going to college, paying for college tuition. There's also a provision that will allow the kids to take the money out of the account for like a first-time home purchase as well, if they're not going to use it for education purposes. So, yeah, little bit different than something like a 529. The other option that they do have is if they don't want to use it for either one, if you do just make standard withdrawals, if the child makes withdrawals from the account, the withdrawals themselves are taxable. So that's where it's kind of a little bit more similar to an IRA, but they do have the option to roll it over to a Roth IRA. So really long-term investment wise, that's going to be one of the smarter, potentially moves to make, in my opinion, with this, is kind of have that additional funding going in there. The one thing that is going to be tough though, is when your kid turns 18, they'll have like that legal control of the account. So you want to be having those, planting those investment seeds in your kids early, so that when they get there, they're not just going to go, oh, great, I'm okay with paying the tax on this and take all the money out. That might be one potential drawback there. So they are trying to be careful with this. The funds have to be invested in like S&P 500 index type funds. Annual fees that are going to be charged by like the fund managers have to be extremely minimal, 0.1%. So they're trying to protect that a little bit. So, all right, I'll go ahead and move on there. All right, so the big one, right?
Oh, here's the one where I'm excited about.
I had to tease all the small stuff. We can just jump straight into bonus depreciation, right? So for anyone who's not familiar, or super familiar with bonus depreciation, huge advantage for us as real estate investors, as well as just, many other business owners, but especially with real estate, is there are certain types of assets that qualify for bonus depreciation. And typically, if you were to just buy, like I'll use an example, like a single family home, when you acquire it, if you don't have something like a cost segregation study performed, the default is that you have to depreciate that residential home for 27 and a half years. Land doesn't get depreciated no matter what, but the building itself gets depreciated over 27 and a half years. If you do the math on that, that means you're getting depreciation deductions of about 3.636% per year. It's nice, but it's a little slow. Takes a while to get those deductions for the full value of the building. However, if you have a cost segregation study performed, that's going to help identify the other components of the building that the IRS knows, hey, these do have a shorter useful life. Things like the foundation and the framing and things like drywall, that stuff lasts a lot longer than a refrigerator, a stove, certain types of flooring that just don't last as long as hardwood, things like that. All those types of things can be identified, and they typically fall in 5 and 15-year class life categories as opposed to the 27 and a half. Now, bonus depreciation is applicable to anything that has a useful life of 20 years or less. And again, keep in mind, these are what the IRS's mandated useful lives for all the categories are, not necessarily what you think logically they should be. I say that because a lot of them are very counterintuitive. But in general, if you were to throw like a rough estimate, just kind of national average, usually 25% of the building value falls into these bonus eligible categories. So being able to take 100% bonus depreciation means instead of depreciating them for 5 years, 15 years, we can actually just take that 100% of that and write it off all in the first year. This is where you'll see a lot of investors talking about generating very substantial losses in the first year that they own a rental property. It's primarily thanks to bonus depreciation being able to accelerate those deductions. Another key thing to keep in mind here with this is all based off of everything. When we're talking about taking depreciation, is all based off of the cost basis of the property. So a question we get very, very often with this is, well, does it matter if I put more of a down payment, like 30% instead of 20% down payment? And the answer is no, it doesn't matter at all. You could have a 95% loan to value or 50% loan to value, and your depreciation deductions are going to be the same in both of those cases. So that, depending on how you look at it, that can be very advantageous. I like to say it's very advantageous considering the fact that we can use leverage to acquire real estate and then generate these very substantial deductions. Now, what we're all so excited about for this is, if you've been investing in real estate for the last 5-6 years, you're probably, we're hopefully working on this with your tax advisor. If not, we'll get you that QR code at the end. But bonus depreciation was 100% for several years, but it started stair stepping down. In 2023, it went to 80, 24, it went to 60, and it kept going down 20% each year. 2025 is originally slated to be 40%. So this going into effect in 2025 is very exciting because that's a huge jump going from 40 back up to 100. There is one small exception to that, and it's this little piece I got here, right here in the middle, the effective date. Unfortunately, and you can, if you aren't familiar with the January 20th date there, that's the inauguration date for the President Trump taking office. If you acquired a property or you had a property under contract potentially before on January 19th or earlier, so basically before January 20th, it'll still fall under the old rules of 40% bonus depreciation. Now, there's a lot of questions around what exactly, like, how do we determine that acquisition date? Because I'll throw out an example. What if I got a property under contract on January 5th, but I didn't close on it until February 10th because I had my diligence period going on and all that? Depending on the nature of the contract, it could be determined that your acquisition date was actually that January 5th date. And the language that they put in the bill said that if you were entered into a binding contract, a legally binding contract, then you would fall into that 40% bonus depreciation category because it was pre-January 20th. That's the big question that's up in the air. And the IRS doesn't have any kind of definition on like what a binding contract actually means. We'll see if they put any like clarification regulation on that. Right now, we're kind of leaning towards attorneys to help out with that. Reason our team doesn't think that the IRS is going to issue solid guidance on this, most likely, is because things like saying legally binding, that will vary state by state as far as what the state statutes and regulations are. So that's why we're thinking that the IRS isn't going to have like a blanket statement for that. They might just say, hey, for tax purposes, this is what it means. But it's very possible that they will lean back towards what state statutes are on that. So that's going to be something that we'll be looking into. If you're one of those folks that, if you're sitting here listening to this and you did have a property that was under contract, those are the conversation you want to start having, maybe with like an attorney like that knows your state, like jurisdiction and laws and things like that, to kind of figure that out. So there is also kind of similar to this. There's a chunk of the provision that addresses property that was being constructed. There's a threshold that you can cross with the property being constructed, like what percentage of it was being constructed before the January 20th cutoff date. I won't get into all the nitty gritty parts on that, but it is possible to potentially break the construction out into pieces. So again, that'll also hinge on this whole determination of what does a binding contract mean as well, because you could have entered into a contract for like a new build, and depending on whether or not it was considered binding, may not push it into this 40% bonus depreciation. So this is something that we only have to deal with this year. Thankfully, all the weird subtle nuance around this date. And the other saving grace here is that 100% bonus depreciation is written into this bill to be permanent. So we don't have that stair stepping down action that we had with the previous bill, the Tax Cuts and Jobs Act, that had that 20% per year drop off. It'll just be permanent going forward. That being said, that doesn't mean that future, House and Congress could change. The administration can change, and Congress can always change things. But at least for now, it creates a lot of clarity for us as investors, whether you're a real estate investor or if you're just an entrepreneur in other sectors as well, because this, again, applies to every industry, even more so than just real estate.
Couple questions in here, Justin. Eric asked, does Hall CPA provide cost segregation studies?
Great question. We don't yet. We are exploring the idea. It's something that we currently do. We have a lot of professionals in our network, since almost every one of our clients is using cost segregation studies. So we work very closely with a lot of the cost segregation firms.
Great.
Yeah. It is primarily more of like an engineering based kind of concept. So it starts to get a little bit removed from like the traditional services of a CPA firm, but we are exploring that, that concept of spinning up a division to do that.
So Mike asked, the solar energy tax credit is going away, and he is installing solar and batteries next year on a rental property. Since it's a rental property, can he expense 100% of the solar battery install equipment cost?
That is a great question. Let me see where I actually have a slide on that. I forget how much further in it is. Find out here.
No surprise here. That's where all the questions are coming in. Everyone wants depreciation.
Well, I thought yeah, I've got a little bit. I can, if you don't mind, I'll make sure that we get to that. In short, I'll answer the question here really quick, because we'll want to delineate later between where the cutoff is for credits, but where the cutoff is for, or as far as like deductions. So the saving grace you would have is that even though the credits are going away, it is property that you could that you can take bonus depreciation on. They were clarified, I want to say in 2022 or 23, to be 5-year property as an addition to the residence. So it would be something that would be bonus eligible, even if it falls into a territory where you're not eligible for the credits anymore. So
okay,
but I'll kind of circle back on just like the credits in general, since that'll be a kind of additional discussion.
Great.
Eric, a question here on if a 2015 in-service date makes sense for a cost segregation study, and maybe just in general, like how far back do you see those making sense if people haven't done it yet?
Yeah, our favorite answer is it depends on all the facts and circumstances. It depends on how long you've owned the property, what your original purchase price was, what this year looks like, where your total, AGI is. If you're meeting something like real estate professional status, you're going for the short-term rental exception, all those kind of things can kind of feed into play. I mean, generally the answer is yes. I mean, if you acquired a property in 2025, even if you're going to be passive, that it's a little bit different situation if you're going to be passive. But typically, if you're acquiring a rental property this year, 95% of the time it's going to make sense to do a cost segregation study. If you acquire a property like in years past and you're wanting to take bonus depreciation on it now, there's a lot more that we would have to factor in the situation to kind of analyze it and make sure it's worth it for you.
His question was 2015, so I'm guessing that's one where you really have to.
Oh, I'm sorry. I thought you said 2025.
Wouldn't that be hard? I mean, it'd be a third of the way through the depreciation schedule, right?
Yeah, you would be able to accelerate the depreciation a little bit. It's outside, 2015 makes it outside of being bonus eligible. But there are ways to basically quote unquote, catch up the depreciation that you could have taken had you cost segregated it in 2015. So that's an analysis that we would definitely would want to break down like in a lot more detail to figure out if it makes sense. We've done it before with like 2015, 16, 17 acquisitions. But yeah, that's a much more variable kind of situation on whether or not it would be worth it. And also how much longer you're going to hold it too is a factor. Longer you hold it, the better. That's a good rule of thumb. So, it's a great question. That's the kind of thing that like on our one-on-one sessions when we're advising clients that we break all that kind of stuff down, because we have to have a lot of back and forth of what about this, what about that, what are you going to do here, to really figure that out. But that's where I really, frankly, we add like a lot of value is if you're wanting some of that information to be able to know, like, should I execute on this before I pull the trigger? Because it's either going to cost me money or time and effort. And I just want to make sure that, and maybe it's a little bit of both. I want to make sure that it's worth my hassle factor and it's also worth my capital. We can help you figure that out before you go and, pull the trigger and then find out come tax season, like maybe your tax preparer tells you like, oh, hey, this wasn't really going to get you much benefit or something like that. We can help you figure that out ahead of time. So yeah, good questions. All right, I'm gonna go and jump in next one here. Right. So, you know, I won't spend too much time in here, but definitely like investment related, you know, a little bit outside of real estate per se. But there was some updates to the research and development deductions. Previously, a lot of the research and development costs had to be capitalized and then amortized. Amortization, if anybody's not aware, is very similar to depreciation. It's just related to intangibles. Well, intangibles literally being things that are you cannot like touch, not physical assets, but are still an asset, if that makes sense. So you know, something that where this could kind of feed into just like the investment pathways and real estate in general is the fact that organizations that will be able to do more of the immediate expensing of their research and development costs, you know, that does have a tangential effect on the real estate market, where that's potentially going to have like new opportunities or whatnot for more facilities like this to be built and more companies to kind of come back instead of offshoring things like R&D. I want to bring that back stateside because look at this benefit. And there's some, it's actually, this is one of the very few provisions that they put in the bill that's retroactive, that goes into past tax years, goes back into 2022, all the way through 2022 through 2024. So some of the businesses can go back and actually amend their returns based off of this update. So that's pretty interesting, but not too real estate related. So I'll go ahead and move on. Okay, so this one is pretty interesting. So for our fund managers, you know, anyone who's investing, you could either be a sponsor, a syndicator that is listening to this, or if you are an investor where you've done LP, like limited partnership investments in the past with syndicators, this is something to be aware of. There is, I'm trying to get too technical here, but there is a limitation. We call it the 163J limitation because that's the code section, and we're not that creative when it comes to making up names for things. So, but the 163J limitation, it limited the amount of interest expense that large funds could deduct if they had, basically if they had limited partners. I'm kind of simplifying for the sake of time there a little bit, but so this was an issue as interest rates started to rise, as especially like we saw a lot of our fund managers, whatnot, kind of being faced with this when they're dealing with rising interest rates, because it limits the amount of interest that the partnership could take a deduction for, and it was limited to 30% of what's referred to as the adjusted taxable income. Now, the definition of like what is adjusted taxable income means. Up until now, it had included taking things like depreciation and amortization. As we were just talking about bonus depreciation, as real estate investors, we want to take those huge deductions for depreciation. The problem for funds, like if you're an LP investor in one of these funds, is that if you took a huge depreciation deduction, but you also had large interest expense, the interest expense deduction might have gotten limited because the depreciation would take the taxable income so low, or usually in most cases negative, that the interest would be limited. There was a workaround for real estate industry specifically, where you could eliminate the limit on the interest expense, but it required you to go to something called the alternative depreciation system. That we call that ADS for short. Well, the problem with ADS is you can't take bonus depreciation if you're using ADS. So it was kind of this little bear trap snare that they threw around this that was like, well, we're going to limit your interest deductions. Well, if you don't want your interest deductions limited, we're going to not let you take bonus depreciation. It was kind of the short version of that. What they changed in this bill that's really helpful, really exciting for those funds, is that we can now add back depreciation and amortization to get to that adjusted taxable income figure. So if we have those huge losses thanks to depreciation, we won't run into, not to say that we won't ever run into the 163J interest limitation, but because we're able to add back one of our largest expenses to get to that adjusted taxable income number, we're going to be able to deduct a lot more of the interest expense, hopefully most, if not all of it. Again, something that the like fund sponsor might want to do some tax planning around with tax advisor. As a limited partner, you might not be pushing that conversation too much, but it is a good piece of information if you're investing in syndications or whatnot as a limited partner, that you might want to ask some questions around that of, hey, what are your guys' plans to work around this 163 limitation, or this interest expense limitation, to make sure that we're still able to maximize all of our deductions at the partnership level. So
we had a couple more questions related to cost segregation studies.
Yeah, sure.
What are the costs of them? How long do they typically take? How do they work on new construction? We'll start there. I don't want to overwhelm you.
Yeah. No, all good questions. So cost, there are a lot of providers that have a what we call quote unquote software study, or more of a DIY, where it's essentially a program. You answer all the questions: how much square footage of tile, of carpet, what kind of window finishes do you have, all that kind of information. Those usually range in like the $700 to $900 price range, give or take. They are less detailed. They work for like lower price properties. If you're talking about $350,000 property, that's where you'd probably be considering a quote unquote software study. Less detail means usually a little bit lower results as well. The engineering, two-part answer there. The software studies, you get the results relatively immediately, since it's being done by a program. Disclaimer on that: if any of the groups if you're looking at doing a software study with anybody, make sure they have audit support. They are relatively young in the tax world, so there's not a lot of case law to back up software cost segregation studies. Cost seg studies in general have been around for decades. So the other type, which is the engineering type studies, are more extensive, more detailed, naturally cost typically quite a bit more. I would expect with a full like engineering cost seg study that you'd be spending at least $3,000, usually like in the low threes. Now that does vary based off of how big the property is, how unique it is. If we're talking about a 30-unit multifamily, that's going to be higher. It's going to be might be in the $5,000-$6,000 range. So, but you can always get quotes from them on that if you have something that's not just a single family or duplex. If you're dealing with a larger property, they'll give you estimates on that. The engineering studies, again, depends on who you go with and what time of the year it is. As you can imagine, tax season, they get a lot of demand. But 6 to 8 weeks in general is a good kind of time frame to get those. We've got the 10/15 individual deadline coming up right now, and all of our cost seg provider contacts, they start reaching out to us this time of year to say, hey, please tell your clients if they're needing to get one of these done to talk to us now. Please don't ask us in September. That being said, you can get cost segs done after the end of the year. So if you buy a property in 2025, you're mulling it over, your CPA says cost segs aren't worth it, and then you're coming to us to get the better advice, whatever the case may be. It's okay if it ends up being January or February to get a cost seg study done on a property that you bought in 2025. So you do have time to get them done, unless you're talking about getting one done for 2024, then you're getting short on time. So I think that answers all of the.
And new construction.
New construction. Not really any major impacts. New construction versus existing. Say a 20-year-old, they're still going to want to go in and do the same type of, like, especially engineering. They're still going to want to walk through the property and take a look at everything. I've not ever ran into a cost seg firm that really wanted much of, blueprints or anything from the builder or contractors or anything like that. They're going to want to go in and make all their own. They're going to do their own analysis on everything. So just because like the things that the builder is going to track are not the types of things that the cost seg firm is going to be looking for. So it's not that the builder did anything wrong with like their plans or anything like that. It's just that the things that they're going to identify when they're doing progress billings and things like that are not going to be the same types of things that the cost seg firm is going to need to know. So they just won't have a lot of the information. So.
All right. And then one more person asked, can you explain the implication of depreciation recapture when taking bonus depreciation up front?
Yeah, I could do a whole hour on that one, but I'll do the short version. So whenever you are looking at selling a property, you're always going to have like the first kind of two breakouts of income is hopefully you have capital gains, right? Hopefully the property has gone up in value if you've owned it for a few years, and generally real estate always goes up. That's why we love it. Say generally to cover my butt, but you're also going to have depreciation recapture. And so that very much depends on how much depreciation you've taken. So if you've used something like a cost seg to generate bonus depreciation, where we're taking that huge acceleration in the first year, if you're at year 5 and you're selling, you're going to have a lot more depreciation recapture. That being said, it breaks further down into, there's 3 different kinds of depreciation recapture. There's section 1245 recapture, recaptured 1250 gain, and unrecaptured 1250 gain. I know it's ridiculous, all the weird terms in there, but those are important because they all potentially have different tax rates applied to it. Capital gains rate, 1245 is different. 1250, the recaptured 1250, I know that terms sound very contradictory, but the recaptured 1250 can have a split between 2 different tax rates, and then the unrecaptured 1250, which that's the term that sounds the most contradictory because it is being recaptured, that has a different tax rate. So, and that all depends on what your marginal tax rate is as well. So, depending on where your income falls, what the property makeup looks like, how many years you've owned it, what your cost seg results originally looked like, is going to make some very drastic impacts on the actual tax liability that you're going to have from a sale. And you definitely want somebody that knows how to really dissect each one of those pieces. If you're mulling over a question like, is it worth it for me to do a 1031? Well, my answer is always going to be, I got to look at the property. I got to look at the history. I got to look at all that information before I can really tell you how many hoops you want to jump through for a 1031, for example. That being said, your maximum rate on depreciation recapture is going to be whatever your marginal tax rate is. So that could be the 24, 32, 35, 37, like whatever those tax rates are. And then the stuff in the middle, some of it gets maxed out at 25% tax rate. So if you're in a 22% tax rate, that doesn't matter to you because the 25% ceiling is erroneous. That's another reason why it matters so much. And then your capital gains. Capital gains will be at the 15 and 20% capital gains rates. So it's kind of a smattering. So my shortest answer I could give, I guess. Yeah, and that's something if you ever need like help again, analyzing that's what you'd want to be like working with one of our advisors on a regular basis. Those are the types of questions that somebody will ask one of the guys on my team. Hey, I'm thinking about doing this. I need to know what the deal is. We jump on the phone, take that 30 minutes or an hour to kind of walk through all those implications and stuff, and then help you plan around it. That way, again, you're not having those surprises when it comes to tax season next spring.
So for all of our viewers out there, we've got about 15 minutes left in the webinar, and I doubt we'll get through all the slides since we focus on depreciation, which is no surprise, but we'll keep going through, and please drop in any questions you have, and we'll do our best to answer every question there is out there, and keep telling about the OBBB. Thanks a lot, Justin. You're doing a great job, man.
Oh, no problem. Yeah. I'll hit the big like real estate kind of investor related things and skip some of the other ones since we're running short on time. All right. So another one, 179 expensing got increased. And so this is, in a lot of cases, it's an alternative to bonus depreciation. We like bonus more because bonus is a lot more flexible. In 179, there are more restrictions on what is eligible in this kind of category, but there are state by state considerations to make here as well, depending on which state you're in. Some states do not allow bonus depreciation. Don't worry, if you bought a property in a state that doesn't allow bonus, you can still take it at the federal level. It's just on your state tax return that they'll have those restrictions. Some states that don't allow bonus do allow 179 expensing. So that is something that's potentially worth analyzing with the property, depending on which state you're in. But we have a little bit of an expansion here as far as like the maximum amounts that are allowed, the amount of assets you place in service during the year that are eligible. There's a different ceiling on there. Won't get into all the nitty gritties on that. Main point being that 179 got expanded, which is helpful. A really big, I will say, like probably the biggest highlight on this is there are certain types of assets that are eligible for 179 expensing that are not eligible for bonus depreciation. So that's the other consideration, is depending on what types of repairs and improvements that you make to the property during the year. This is specifically for non-residential. Unfortunately, residential doesn't get all this extra benefit, but non-residential properties are able to tap into more 179 deductions when they are operating. So, for all the short-term rental listeners out there, short-term rentals, and again, this IRS doesn't always make a whole lot of sense with logic here, but short-term rentals are considered non-residential. Does not matter if it is a single-family home that you're making as a short-term rental. It's all based off of the usage of the property. So that actually is a pretty big advantage for short-term rental owners, is that they have more options for tapping into 179 expensing than typical residential property owners do. So little food for thought there. I'll hit this next one real quick because it's definitely real estate related, a little bit obscure. It's called qualified production property. It's a new term that's coming into the tax field for us, QPP. This one's pretty wild, in my opinion, one of the more wild provisions. Typical non-residential property has to be depreciated for 39 years. And if you buy something like a warehouse or self-storage units, things like that, those are 39-year non-residential assets. So slower depreciation than residential. Now, why QPP is really exciting for this is if the property is used primarily for manufacturing. And again, there's some restrictions on this, and you can't go willy-nilly and just say like, oh, we'll use it for 2 years for manufacturing. But if it's being used for qualified production activities, and that's a term that they've coined here in the bill as well. So they're going to have some clarifying language, I'm sure, on exactly what that means, but basically means making products that are not food or beverages. So what we typically think is manufacturing. If it falls under all these categories, the entire amount of the building can be written off in the first year. So we talked about cost segs real quickly. They're generally like 25% of the building can be, taken as bonus depreciation. If you have a property that's qualifying as this qualified production property, 100% of it could be written off. Again, there's some prickly restrictions in there. One of them being that you cannot, as a real estate investor, buy one of these and lease it to somebody who's going to manufacture. What we're thinking may crop up out of this is we might start seeing partnerships between operators and real estate investors to come together. And, you basically say, hey, I've got money for the real estate. The other guy says, well, I got all the manufacturing know-how. So instead of doing them as separate businesses, we'll bring them together. We'll see. We're waiting to see. If I wouldn't jump on this immediately necessarily, but we're expecting that might be a big strategy that ends up getting deployed over the next couple of years, especially after we get more of the Treasury regulations to make sure that they don't restrict things like that. Like say limited partners not being able to tap into it, for example, could be a thing that they throw in there, but we'll see. But the fact that you'd be able to write off 100% of the building is pretty wild in the real estate world. It kind of takes bonus depreciation on steroids there. This next one is going to be is a pretty significant potential impact for anyone who's high net worth, ultra high net worth. It's really called excess business loss limitations. I'm trying not to get too technical on this one. What the general idea is when they put the excess business loss limitations in place, they're literally trying to keep high W-2 earners from taking business losses to offset too much of their W-2 income. And so for context, in 2025, the limit of W-2 income you can offset with business losses is $626,000. So if you had, huge like real estate investment or, like big investments in other businesses that are taking all kinds of bonus depreciation and assuming they're not restricted by the passive loss limitations and you're actually able to take them as non-passive losses, you could be restricted further by this excess business loss provision that limits you. And that $626,000 is for married filing joint. If you're single, cut that in half. It's $313,000. But all that being said, we don't run into this super often because you've got to be in that. You got to have enough income for this to be an issue. So typically we see this with our clients that are W-2 earners of like 1 to 2 million, 2 to 3 million, somewhere in there. The thing that they didn't change in here is in the original version of the bill, the House version of the bill before it went to the Senate, they were going to close a loophole that existed on the EBL here. Senate pulled the language that was going to close the loophole out of the bill, and the final version of the bill got passed and signed without closing the loophole. So basically the loophole still exists. The loophole, and I very, very rarely use the word loophole, but it actually really legitimately is a loophole in this because it wasn't intended to be there originally. If you have business losses that are over that $626,000 threshold, in the second year, it turns into something called a net operating loss, an NOL. And the net operating losses don't have the same limitations as the excess business losses do. So it enables you to convert the losses that were previously restricted by this excess business loss provision and turn it into a more flexible, more useful loss carry forward. Real quick example would be, you have a huge income event, maybe a bunch of stock that you sold a business, anything. So maybe you've got $4 million of income come your way through like something like a W-2. or you know that that's coming next year would be a better example. If you generate a bunch of business losses in 2025, you'd be capped at that 626,000. But let's say you generated $2 million of losses. When it rolls forward to the following year, it changes from business losses to that net operating loss. And you're much more free to use the net operating loss in the following year to offset more of your W-2 income when it's going to be really high. So this really creates a really unique, but a very, very huge planning opportunity for, 1 year to the next on when you want to try to generate your losses as well. So it's pretty tricky, but very interesting that they allowed that loophole to stay open. We'll skip spaceports. R&D, let's see. We don't need to talk about international tax. So let's jump over EV credit. I know that was something that got asked earlier, so I'll just mention that real quickly here. So EV credits going away September 30th. That's the big cutoff. The key with that is if you have a vehicle, say like a Tesla or something like that, that you're supposed to get the credit for, you got to take delivery on it before that date as well. So you can't just have one ordered. If you got one ordered and it's not going to come until after September 30th, unfortunately, you'll be one of the folks that loses that benefit. This largely is just kind of the signaling to move away from the green energy credits. A lot of this was stripped out to be able to pay for some of the other tax breaks that are being given. Similarly to that, we have something with the solar credits. Very, very similar type of situation, except this one the cutoff will be December 31st, 2025. So that's another one where you want to have it paid for and installed by December 31st, 2025, because those will be going away starting next year. Again, to the earlier gentleman's question, that you'd still be able to take deductions for these if you're putting them on rental properties, be able to take things like bonus appreciation. It's just that the credits would be going away. Credits were something that you could get on a personal residence as well. So that's a minor slight there to that provision. Like same thing on the investor kind of side. A lot of the clean energy credits that you could get for some like the new builds is being phased out as well. So there's going to be some impacts there, which is it's going to be less advantageous due to solar. And the 179D energy efficient commercial building deduction, similar phase downs happening with that. Those ones are a little bit further in the future. Like we've got 45V is code section for it, but those will end in 2027. So some of this stuff is, as far as like the green credits are being phased down through like 2026 and 2027 when it comes to like energy efficient buildings. Something to keep an eye out for there. But I'll leave a couple more minutes there for just if we have some follow-up questions here. I'll jump here to the end. That was about all we could get in there, I think.
Yeah, this was great. I see one question on here. Linda asked, were there any changes to 1031 exchanges?
Oh, good question. No, that one got left alone. It's been Congress people like to bring it up every once in a while to put it on the chopping block, and every time that it does, it gets shot down, thankfully. So they didn't make any kind of changes to touch 1031 exchanges. So those will still be there. Yep.
Christy says asked, does 100% bonus depreciation apply to business vehicles purchased before 2025? Would that bonus be able to offset capital gains from the sale of a rental property?
Okay. That's a good layered one. Possibly. So if you had a business vehicle that you bought in 2024 and you were using it for business, maybe that was for your rental portfolio or some other kind of sole proprietor type business that you run, then it would be eligible for the 60% bonus depreciation. It could potentially also be combined with that Section 179 expensing. So that's a situation where you'd have that 179 maybe would come in and save the day. The other questions at play there are like, what business was it being used for? If it was being used for something like your rental portfolio, we might have some additional questions of, are you qualifying for real estate professional status? Do you have losses from multiple rentals in your portfolio, or is your portfolio generating taxable net income, in which case reps doesn't matter as much anymore. But yeah, generally you could, and it doesn't directly offset the capital gains in the way that you'd probably think, as far as like, well, I got 20,000 capital gains and a $30,000 loss from the vehicle purchase. They are somewhat independent in that the 20,000 capital gains would still, and it's actually advantageous to you for this. The $20,000 of capital gains go to the capital gains tax tables. So you get those preferential 15%, 20% rates. But then if you have a loss via the all the accelerated depreciation you take on the business use of the vehicle, those would actually come in and hit your marginal ordinary tax rates. So you could actually be taking deductions from the vehicle, like 179 and bonus depreciation. Those could be taking bites out at 32, 24%, whereas the capital gain income is being taxed at 15%. So you actually get an even better result there, in that it is reducing your total taxable income, but the flow of it is a little funky there. So yes, kind of.
So a follow-up question on there: can you use bonus depreciation alongside an EV credit, assumed purchase before the September deadline?
That is a great question. So whenever you're looking at stuff like the credits, they will reduce the basis that you're able to take depreciation on, to like typically dollar for dollar. Now the EV credits though are on the personal side, like for the vehicles specifically. It's a little bit different with
Yeah.
solar panels that you put on a residence, because that's governed by a completely different code section. Whereas the EV credits for the vehicles are different from like the depreciation code section. So it's, if you're going to buy an EV vehicle, it's usually better to like buy one and have it just be your personal use, because then you can take the credits. Alternatively, if you're buying it for business use, your main goal there would just be to take the bonus depreciation and like the 179 to be able to just write off ideally the whole thing, as opposed to getting the credits. And depending on the situation, one could be more advantageous than the other. But if it was me, I'd buy the EV for me personally, and then I'd buy like a full-size pickup truck for the business. That's kind of the best of both worlds. Good question.
Okay. Someone asked, are these slides available, or will they be available? I think the answer is no. You guys generally don't share these slides, right, Justin?
Yeah, we typically don't, but we have a bunch of content that is just like publicly available. I could send you guys, we've got a handout that's more of like a PDF version instead of the horizontal PowerPoint slides, as a nice like overview of all this. And again, if you're looking for more information on there, we have a lot of this being put out there on our website. Just go to therealestatecpa.com, and we have a ton of resources there that you can tap in all this. And if there's potentially going to be more changes coming in September. They're already talking about like what the next bill is going to look like, because they knew they couldn't get everything done on this one. So we'll be monitoring that. Our manager of our national tax office will be monitoring any developments that go through Congress. We did the same thing with the BBB here, of every iteration that it changed. We'll have that information being constantly posted to our website. So there's more impacts there. You can tap into that. We also definitely encourage you to look at, becoming a client. So you're just getting that direct tap to us, like one-on-one with clients. But we also have a client community that it is a private community. So it's paid subscription type of model that you can join as well. So that you get, we don't have a one-on-one advisor with the community, but you do have access to our team of advisors through there. So there's a lot of options that we have as far as just free content you can grab. If you want to become a client, have kind of more white glove experience, work directly with one-on-one with an advisor. If you're a real estate investor and you're making moves each year, that's definitely going to be where you're going to get the most value, where I'd recommend that you start. And you can always have an onboarding conversation with our team, our onboarding team, just to see like what's going to be the best fit for you as well. And there's no charge for those.
Awesome. Well, I know we're a few minutes over, but Justin, thanks so much. Great presentation. That was jam-packed. We'll have you back here once the September bill makes its way through everything. And of course, if you guys want to talk with Hall CPA, use a QR code there. I've had a few clients use them, and they rave about them. And a big shout out and thank you to Brandon at Keyrenter Denver for co-hosting the webinar with us. Of course, you guys are out here in the Denver area looking for a good property manager. Reach out to Brandon and his team. They specialize helping landlords, take the headaches of their rental properties. And also, they also bring lots of great education like this to their clients. So I see lots of thank yous in the chats. So Justin, thank you. Brandon, thank you. Everyone out there joining us today, thank you for joining us.
Yeah, thanks for
Bye,
having me.
everyone.
Thanks, Justin.
See ya.